One of the most common questions I get all the time is, why do I not set stop losses? Why am I not interested in setting stop losses? It's a question I get so often from people, okay? And I'm gonna explain why I don't do this and why it does not make sense for me whatsoever, guys. So first, a stop loss basically means if you are in a situation where you buy a stock, okay? So let's say you buy a stock for $10 a share, all right? You buy the stock for $10 a share. What you could do when you're in a stop loss, basically, is you could say, well, if these shares go under 950, then I want them sold, okay? I want them sold under 950. And you could also set it for certain brackets, like I only want to sell between 960 and 940 or something like that. Like, you can play around with it, but a lot of people just do a straight stop loss, where basically, if the shares were to go under 950, then their shares would automatically sell. You could do a portion or you could do them all. A lot of people just put all their shares. So if they buy $100 in share ABC at $10, they'll put in what's called a stop loss. So if those shares go under 950 for whatever reason, they automatically all get sold, okay? There's a lot of different reasons. I want to get into one quick one. This is not the most important for sure, but I just want to get into one quick one. First off, a lot of times after earnings, I've seen stocks where they go down a ton and it'll maybe open at something like an 880, okay? The stock opens at an 880, and obviously the person's shares get sold at that price, right? And then I've seen in the same exact day, those shares come all the way back to nearly the $10. I've seen times where it's actually gone positive, okay, where this stock is down massively, and then obviously the buyers enter in and the stock just ends up going up massively throughout the day, and then it ends actually higher than it did. But these people got screwed because they sold at 880. That's just one reason, but that's actually the very, very small reason compared to these other reasons I'm going to give you guys on why I don't personally do it. And for you, it might work for your style. I'm not saying it's bad. If you want to do it for your style. For me, it doesn't make sense. It's almost against my religion, okay? It's almost against my investing religion. Because what I do, it's almost like, have you ever seen the movie, the original Die Hard movie? There's a scene in the Die Hard movie, right, where you know, the bad guys, Hans and those guys, they're talking and they say, oh, the FBI just showed up, and Hans goes, that's all part of the plan. And they're like, what? Why? And it's because the FBI had to shut off the electric. Stock going down is all part of the plan. That's best case scenario for me. Because let's say I buy these shares of the company for $10 a share. Well, first off, when I usually buy shares in a company, I'm buying a very small percent, okay? I'm usually buying between 1% of my portfolio total, and sometimes it's even less than that, honestly, guys. Sometimes I'll put it less than 1% of my portfolio total into a stock when I initially buy it. At the maximum, I will usually buy about 5%, and that's absolutely the maximum I will usually go into a stock initially, okay? So usually it's somewhere between 1 to 5% of my portfolio, meaning I'm going pretty small into this stock. So let's say I put 1% of my portfolio in this stock, okay? So, you know, let's say if it was a 100K portfolio, okay? If it's a 100K portfolio and you put 1% of your money in, then you buy basically $1,000 worth of this stock, okay? So you own 100 shares of this stock. Now, my plan is whenever I buy into a stock, I hope it goes down because, one, I'm buying this company for several years, okay? I'm buying it for several years, and I want it to get even bigger stake built, right? If I only got 1% of my portfolio and I really love this company, I would love it if those shares go down much more, okay? So that's kind of what I'm hoping. So the fact that maybe those shares go down, that might all be part of the plan. So let's say these shares drop massively. Now, this would be an extraordinary situation. This rarely happens, but let's say those shares went all the way down to $5 a share. Obviously, I would be very interested in buying many more of those shares as long as I still believe in the company. I still believe in the long-term future. So then, guess what? I can buy these shares for half the price I did initially, and I can add a much bigger position now at this point, because if I was adding 1% of my portfolio, I might want to add, you know, now 10K at this point in time if I still really love that company. And how many shares can I get now at this point at 10,000? Obviously, a massive quantity. So then I could buy 2,000 shares in this company now at this point, okay? So now I have 2,100 shares, and my cost basis is close to $5 rather than close to $10, okay? Now, usually I'll buy on the dip. So let's say the stock went to $9, then I might go ahead and double up my position. If it dropped to $9, it drops to $8, I might double up my position again, okay? Drops to $7, I might add more shares, or at that point, I might buy call options. By the way, I got a call options course $10. That goes into all different options. It's linked in that description. It's a second link there that goes into all options if you want to learn about options, okay? But I might buy options at that point because that just gives me an ability to buy obviously a much bigger position and get much more upside if that stock jumps up over the next year or two, depending on how far out I buy those call options. And I can buy those call options for generally much smaller dollar amount than I can actually buy the shares for straight up. So that's a position I might make. So when I'm looking at a stock, I'm obviously hoping it goes down, okay? So why would I set a stop loss if I believe in this company? That's all part of the plan. The ultimate plan is that stock goes down. Now, if it goes up, you know, and I buy for $10 and it goes up to $11 or it goes up to $12 or it goes up to, let's say, I don't know, $14, okay? Let's say it goes up to $14. I'll probably just sell out. Yeah, I had a very small position in it, but hey, I made a quick profit on that. That's real nice. I get to take my profit and run. But really, when I'm going in a position, I'm thinking about it like this stock in the short term, it's a 50-50 chance if it goes up or down. It's a 50-50 chance if this stock goes up or down. That's why I want to make a small position in it because I don't know how to time the market. I don't know how to, you know, day trade and things like that or short-term trade. I've never seen it done successfully over the long term from anybody ever, so I'm not risking that. And if you're doing stop losses and things like that, and then you're not really a long-term investor in company. You're kind of just like doing trades and whatnot, you know, and that's a whole different philosophy than what I do. My investing religion is long-term investing. If you're doing stop losses, you're not a true long-term investor because if you're a true long-term investor, you're thinking like I am, oh, I buy these shares for $10. Then if they go down to $8, it's just that much better of a deal. As long as I feel just as confident in the underlying company. If it goes down to $8 and I bought them for $10, I want to buy more at this point in time. I'm going to buy the dip, guys. So that's what a true long-term investor, if you're a short-term trader or day trader or whatnot, then you can do stop losses. But you cannot consider yourself a true long-term investor, especially any type of true value long-term investor, if you're doing stop losses, in my opinion. It just doesn't correlate, okay? You're more of a short-term trader at that point because your mentality is way different if you're trying to, you know, buy and sell on dips and things like that, guys. That's a way different thing. So for me, it just does not make sense to do stop losses, you know, and as far as positions, all time, and I think I've shared this once or twice with you guys, all time, there's only been one position that it's 100% for sure not worked out on, and that was Pandora, okay? And the only other position it's probably gonna not work out for me, unfortunately, is GoPro, okay? So 9 years of investing for me, 9 years of investing, and I basically have 2 stocks to show that it did not work out for me where, I went in, I made my initial position, it went lower, I bought more shares, it went lower, I bought more shares, and it did not come back to above where I started buying those shares at. 2 stocks ever, and this one, you know, we can make an argument that maybe it still comes back or whatever. I'm not counting on that. We could just count that as a loss, okay? So 2 stocks ever? And the gauntlet of stocks it has worked out on, why would I change my philosophy just to maybe prevent from these 2 situations happening when I got 100 situations that it did work out on? So that's my philosophy behind it, but I'm not hating on you. If you use stop losses, just don't call yourself a long-term investor if you're using stop losses, in my opinion. That's just not, you're not a long-term investor at that point. You're just trying to do these little trades. It's like you buy you buy an actual McDonald's franchise. If all of a sudden your sales go down 10%, you know, one week, do you all of a sudden say, oh, I need to sell this McDonald's now? No, you end up keeping that McDonald's and be like, we need to do this and do that and things like that, guys. So I hope you enjoyed this day. One of the most requested, questions I get on the channel often is about stop losses and why I don't use them. I hope you guys enjoy this day. Make sure if you're newer to the stock market or you want to know exactly what I look for in a stock, you click that first link in the description down there. That goes into exactly what I look for and how I pick stocks, guys. Thank you for watching and have a great day.